Marsha Vande Berg.
Yeah.
Okay.
Okay.
Make sure I'm emphasizing the right syllable.
You want? Do you like your shot?
We're going to go half an hour, or
20 minutes, 25 minutes, somewhere in there.
okay, good. Okay, good. Then I can get on the road before the traffic.
Yeah, let's get you
Are you good with that
Yeah,
much?
yeah.
out of here by
For
3:15, 3:20.
Yeah.
Okay.
Yeah. I mean, if
For
we
sure.
push in and then move left, but I don't mind. I know it's more than we had when we did Rome.
Yeah.
But I think what it
How's
ends up
Roman's
being
girlfriend?
Patricia?
Hold on.
Yeah.
You can push
I was
in
thinking it
and
was
then
Judith,
just
but-
slightly to the
No,
left.
Patricia.
Okay.
All right, there we go.
Got a little headroom.
Oh, sorry.
I'm getting perfect.
Alright, there we go.
You guys are quick.
Ahead of ourselves. Alright, so rolling.
Rolling.
And then let me know when you speed.
Introduction, same space.
Rolling.
Yeah. Yes, please. Yep.
So you just talked to me, but
Yeah.
okay.
All right.
Alright, and then I don't know if you can tell from over there, Ryan. I think I'm in both.
Last name is Vande Berg, if that makes any difference.
Yeah.
It doesn't matter to me, but
I'm just
So
going
they
to
can
start
track it.
running into there. All right, ready,
You're in
perfect.
both.
This is going to be for finance, Marsha. And then let me know if you can see. Yep, good to go. All right. Perfect. Give me a quick second to settle. All right, anytime.
I'm excited to have as our guest Marsha Vande Berg, who is joining us today to chat about a wide variety of topics, but all centered on the idea of institutional investors' interaction with the markets and with companies, both private and public, around issues of, and don't worry, we'll define this, CSR, ESG, and some other interesting acronyms. But first, I want to just highlight some of her remarkable accomplishments and say that for my purposes, I'm excited that she's an affiliate of the Rock Center. We got to know each other while she was a DCI fellow here at Stanford after a really remarkable career in this space, including as CEO of the Pacific Pension Institute, which is where she had an opportunity to play a leadership role and interact with so many global institutional investors. And I understand now that not only are you writing a book on this issue broadly, you're a frequent contributor to Rock Center efforts, including in Hong Kong and here in the United States, but you're also serving on two boards, both boards on their audit committee, and one is Tata Capital, and the other one I think is Quantum Advisors. And we might have you tell us a little bit more about that, but I think a lot of people will certainly recognize the Tata name and will maybe define why those companies are so relevant to these spaces and these issues.
right.
So the opening question, I think, is for students who and participants who may not know a lot about what the area of quote-unquote CSR and ESG is. And I wonder if you could just take a couple of minutes to lay the groundwork for us. These are concepts and topics that have been around for a long time, but maybe some
Right.
definitions and descriptions.
Okay, terrific. Thanks, Dan. Thanks for the introduction. I'm delighted to be here and joining you in this conversation. Acronyms bedevil all of us, and especially in this area. There's multiple acronyms. ESG, people who are very familiar with this field quibble with ESG. They say it should be just ES and not the G, or GES, G and E and S, because really at the end of the day, when you're talking about E and the S, you're talking about governance. And then governance has its own kind of set of individual factors. But ESG is a umbrella strategy.
And what does the E and the S stand for even?
E is,
See, look at that. We're using acronyms without defining them.
See, E is the environment writ large. S is social issues writ large.
Okay.
And under social, that's the fuzziest of the E and the S and the G. But under that is employee relations.
Okay.
It is community relations. It is human rights in your supply chain if you're a global company. It's those kinds of things where people interact, and what a company is doing, either domestically or internationally, affects that community where they're operating in.
Okay.
So the S are the social issues that are impacted by virtue of what the company is doing with its delivery of its products, delivery of its services, whatever its engagement is in business. So the E is environment, S social, G is the governance.
Okay.
And when you talk about ESG, it has its own application in investment, its own application for business, for corporations, for management, for corporate boards. But basically, it's an umbrella term that refers to a risk strategy. So that's very important for boards, very important for management teams, and very important for institutional investors. And it's increasingly important for institutional investors who are your long-term investors, patient capital investors. They include the very large asset owners, your big pension funds. They really own a sizable share of the market, both private and public market. They are big players. And when they get concerned about risk strategy within companies, people tend to pay attention. Corporations tend to pay attention. So the prominence of ESG strategy, the umbrella term, is really, I think, the result of increased and heightened interest among institutional investors. Now that's the ESG strategy that you also asked about CSR.
Before you jump to that, let me just jump in and clarify a few things. I think that's a very clear definition, very helpful. When we say institutional investors, it's such a broad term.
Sure.
By way of example, when you say large pension fund, you might mean, say, CalPERS or CalSTRS, which are the large pension funds for public employees and for teachers. But also, I think that includes, and maybe expand on this for me, the likes of BlackRock. Now, there's a little bit of overlap in this, right? So BlackRock is a big money manager, and they have lots of assets. Sometimes they're managing those on behalf of the CalPERS and CalSTRS, but they're their own entity. Could you maybe throw out a couple other examples of big institutional investor players, whether pension funds or otherwise, and maybe give us a little hint as to their nature? I know they're very different in some aspects, but they do share this large footprint in the marketplace and kind of, on average, a very long view as to how long they need to have their assets invested.
Right. Well, if you think about them in sort of two camps, two buckets, if you will, asset owners and asset managers. So an asset owner is like a pension fund, and they are fiduciarily responsible for the assets they manage on behalf of a set of beneficiaries. And those beneficiaries are the current public employees and then the pensioners.
The retirees.
And the retirees. And that goes on into the future. They are long-term investors on behalf of generations into the future. So they sit on the assets, they own the assets, if you will, by virtue of their fiduciary responsibility and their duties, and all that's laid out in law.
And they've collected money over time, arguably from both the employee and sometimes the employer. And they've amassed that, and then their job is to balance short and long-term liabilities, get returns on those assets, and hopefully match it to the liabilities that are arising as people retire.
Precisely.
And people
Yeah, precisely.
Not an easy job.
Not an easy job. And that's where a lot of the contemporary debate about the funding levels of these pension funds comes into play. You know, is a fund 70% funded? Pension fund 70% funded, and is that sufficient? That's the key thing. And that gets into then contributions to the pension plan, government contributions to the pension plan, and a lot of other pieces to it. And on the other side of in the same category of institutional investor are your asset managers.
The managers as opposed to owners.
Managers. And like you say, there is some overlap, and they do manage assets for these pension funds. And now, not all pension funds are in the same category. They are large, they are small, they are middle-sized, and they have varying degrees of bureaucracies under their individual roofs. CalPERS, CalSTRS has, for instance, a governance department, has a governance team. They have a very prominent person on the staff.
Because they're pretty big entities, right?
And they're
These
big,
are large,
and they do a lot in this
wealth,
this space. But you go further down in terms of assets under management, and you'll find a lot of pension plans, funds don't have that interest or that capacity, or they're just not driven in that direction, and they tend. Well, all of them engage in the debate: do we manage our assets in-house or externally? Do we farm them out to an asset manager? And that's where some of the issues around ESG come into, but we can get to that a little bit later. Just for the time being, there's that group of asset owners who both manage their assets in-house
Right.
and then manage assets, outsource those assets.
They tend to be bigger, right? Because they're
Tend
at a
to be,
scale that
yeah.
they can do both of those.
Yeah, but
Okay.
it gets to the issue of expertise. It depends on whether you want to have an in-house team, and you have to have then the expertise within that team be industry-wide competitive. If you think about a private equity
Right.
department within CalPERS, for instance, and CalPERS goes back and forth about whether to outsource or insource
Right,
private equity,
right.
for example. But as you get further down, and so, and your smaller pension fund will tend to, or your family offices will tend to, they're an institutional investor too, will tend to outsource. And so you have in your asset manager category, you have the really big three, which are BlackRock, Vanguard, and State Street. Those
Okay.
are the really three big called passive investors.
Okay.
So they really invest an index, more or less, or they've
Okay.
got all kinds of products that you then, well, that's for the retail investor, not so much although it is also for the pension fund.
Although we've talked about these with our students, and Roman Wheel, highlighted the fact that though ironic, he was on the board of a mutual fund that prided itself in picking effective managers who are essentially the opposite of an index, because they're using discretion to
Right.
pick stocks and hopefully beat their index, right?
Right, right.
And that his view was, generally speaking, that probably doesn't pan out, that indexes are actually hard to beat over the long run.
Right.
So these big three are, at least on the retail end, because you and I put money into mutual funds and hopefully pay very, very little for that privilege, right?
Right,
5
right.
basis points, which
Right.
our students now know means 0.05%.
Yeah.
They are putting a lot of money into indexes.
Right.
And so they are in the market space writ large, which
Right.
I guess is a part of the explanation for their attention to some of these matters, because it's not easy for them, as I understand it, to simply walk away from a particular category or sector or even company if they are, for example, in the S&P 500
Right.
or in the Russell 3000.
right.
They can't say vote with their feet, because they've committed to being kind of an index
Right.
strategy.
Right.
So maybe, so we can come back around to it, jump into the CSR distinction discussion, and then maybe come back.
Well, Can I?
Yeah, no, expand on that. Yeah, absolutely.
This is just in my head, and I just wanted to say that on the asset management side, there are passive asset managers and active asset
Okay.
managers. And a mutual fund, like Roman is talking about, if you think about a mutual fund, they have to compete for money.
Right.
I mean, if their returns are down, they don't get inflows. They're dependent
Yep.
on really being aware of the norms and the values and the changing norms and values that are happening in our ecosystem writ large. So even the mutual fund, and that gets into the ESG and the CSR piece. But I wanted to make the point that the active, or the asset managers, both active and passive. And it's the three big passive investors who have played so prominently in this space of ESG, risk strategy,
Yeah.
played so prominently in that space by their pronouncements
Yes.
about what corporations should do
Right.
if corporations want to keep them at the table in terms of being an investor
Right.
in their companies. And as you say, it's very difficult because they're so broadly invested for
Yeah.
them to walk away.
Right.
What they do have, though, I mean, in terms of their clout, is they can serve, say, as the swing vote in a very controversial shareholder resolution that's pending before the AGM. BlackRock, who may own a percentage, say 3 to 4% of that company's stock, says, well, I'm going to side with the Christian Brothers and the New York Commons, who are challenging, say it's ExxonMobil, challenging ExxonMobil in a shareholder resolution context. So that's where they're prominent, where
Right.
they're important. So you've got the asset owner, you've got the asset manager in those two categories of active and passive.
And just as background, that prominence and that power in some ways has increased over time, in
Yes.
part because the total balance of holdings of public equities in the United States, for example, has increasingly become in the hands of institutional
Yes.
investors of all sorts, of course.
Yeah,
but
yeah.
we tend to banty around the number of 70%, give or
Yeah,
take, is
yeah.
institutionally held, as opposed to held by retail investors. And so, first of all, that's a large percentage. But among those, I think I'm just restating what you just said, there are some big investors who may hold of even a very large company 1 or 2 or 3 or 4%, and so on the margin in matters that call for shareholder vote or shareholder attention, that can be enough to make a difference. Which, if you think about the game theory side of this, that means that if you're a director or management of a company, you need to pay attention to what the likes of BlackRock says, and maybe tying it to your broader point. So the head of BlackRock has been writing letters in the last few years, and he does an annual letter, and the last few letters have really invoked this idea of needing to have a broad view of the impact a company has on not just its shareholders per se, but everything. And it sort of invoked, it was almost a call to arms of sort around ESG, CSR, this area. Can you talk a little bit about that?
Yeah, precisely. And it's not just Larry Fink of BlackRock. It's also the head of McNabb, William McNabb of Vanguard, and then the head of State Street has also issued a letter. And so you've got those, and it's by virtue of their size, but also, and their size commands media attention. And so that's been a factor too. But Larry Fink's two most recent letters have underscored the notion of corporate purpose. This is different from CSR, but it is corporate purpose means he uses that in the sense that corporations no longer are entitled to be in a community to earn a profit. They are privileged to be in a community to earn a profit, or a region to earn a profit. And so it's signaling a bit of a switch in our thinking, in the larger thinking, the macro thinking, about what actually is corporate governance. This gets to the larger issue. And I can answer what's corporate purpose versus CSR if you like. And I think you would like that. I'm sorry.
Yeah, for sure. No, it's good.
But it's indicative. It's signaling this evolution in corporate governance, and we can come back to that history in a moment. Just to your question specifically about corporate purpose versus CSR. CSR is corporate social responsibility, and is typically a voluntary program that a company takes on and promotes doing good voluntarily within a community. It's a very good practice. It's been around for a good long while, but it is typically voluntary. In a country like India, which has a very long tradition of community involvement and employees first, companies second, if you will, it is mandatory. So the law of the land is, if you are a publicly traded company in India, 2% of your net profits go to charity. And it goes either to the charity of your choice, or it goes into a kitty, which may or may not be a good idea, but it goes to the charity of choice. Anyway, so India is a different story. Typically it's voluntary. That's corporate social responsibility. And if you and I are employees for IBM, we might engage with whatever. Or I can remember back when I was employed, my company had employees sign up for United Way, and it was voluntary basis. So that's really CSR. Corporate purpose is a little bit different thing. It goes to the rationale for companies, for businesses doing business, where they're doing business, and it connotes the interaction between that business and the ecosystem that they're doing business in. Ecosystem is a word that gets used a lot, but it happens to be a very convenient catch-all phrase because it has to do with how they interact with their own employees, but then their employees' families, the schools, the community, the region, the supply chains that bring them whatever they need, and on it goes. So it has to do with how they see themselves in the larger context, the larger scheme of things. What are they privileged to do? What is their responsibility? What are they accountable for? And I think those words, those concepts, are what are getting a higher profile under today's evolution, under the evolution that's happening today in corporate governance.
So let me jump in and so as a if you are a sitting director or a longtime CEO, dare I say old school, we'll get back to that.
That's all right.
And you hear this, whether it's CSR, which I understand is, we'll kind of put in its own little category, corporate purpose, which is the kind of latest, kind of iteration of this, and coming from powerful, institutional investors, and then of course the ESG effort. What are you to do when once upon a time you thought to yourself, well, I thought my job was to be a profitable partner and right? So this idea of focusing on, within the boundaries of law and ethics, this idea of making a profit on behalf of shareholders, and now it seems more confusing insofar as there are these other considerations which may or may not, particularly in the shorter run, align with profit maximizing, which at least in the United States has been a fairly consistent mantra around shareholder, focus, shareholder and share price maximization on behalf of the shareholder, which is often thought to be about a balanced approach to profit maximizing. Now, of course, it's much more complicated than that, but this seems to complicate that story. Is that a fair interpretation, or is it a longer view or a more complex view? What does Larry what does he mean when he says you need to have corporate purpose, you need to earn the right and demonstrate the right to participate in this ecosystem that gives rise to your profits? It's hard to understand what that might mean. Can you give us maybe some thoughts and examples?
Yeah, I think maybe the best example would be the Deepwater Horizon and BP oil spill.
Okay.
Which happened in 2010.
Okay.
I think we just looked it up, 2010. At that point in time, BP had a history of problems, safety violations. There was a history of problems. And they had a license to drill in the Gulf of Mexico, and their rig blew up, killing 11 people, causing the largest oil spill in all of history, and it still stands today. Thank goodness we haven't had another one that's that bad. But that fact of BP being in place in the Gulf of Mexico at that particular point in time, drilling in very, very deep water, not being, and as the litigation showed, and as the fines that they paid attested to, they did not have the necessary precautions in place, the necessary safety precautions in place to prevent that kind of accident. Now you can argue accidents are going to happen anyway, and granted they are, but the fact that they had not been held accountable over the period of time for not having greater safety measures in place, having had one accident and then another accident, not having put that in place, that their board had not held management accountable in an industry that is natural resources, drilling and excavation is an industry where those kinds of safety features are key, where they should have, if they didn't have, a safety committee as a committee of the board. It's so integral to the business. That this whole instance, the fact that happened, the fact that there was not greater accountability within the corporation, both on the board side and on the management side, to take care to make sure they had both the state-of-the-art drilling equipment and state-of-the-art safety precautions. That kind of risk management and that kind of risk strategy is what Larry Fink is talking about when he's talking about corporate purpose. He's talking about companies needing to take account of what are of the climate, of the environment, of the kinds of social issues, taking account of the impacts that will render them either more capable of doing business or less capable of doing business over time. Remember, they're long-term investors, all of them are. So when he talks about corporate purpose, that's really what he's saying, and he wants and so do the institutional investors writ large. What they want is these companies that have exposure, and every company has some kind of exposure, have exposure to take those exposures into account when they figure out what their revenues are, what their revenues are going to be, how they project those revenues, and how they then structure how management then structures its resources and puts in place the proper safety requirements. And once again, it depends on the kind of business that you're in.
Right.
A manufacturing
Right.
business or a natural resources extraction business is going to have a different set of criteria that
Yep.
come into play here when they think. But those kinds of long-term impacts on what you do and your capacity to do what you do are very important. ExxonMobil might be another case in point. ExxonMobil has a petition pending before the SEC, and that petition asks the SEC to, in effect, and SEC can't halt a shareholder resolution, but it can give support to the company's position, which there's a shareholder resolution pending that says we want ExxonMobil to show the rate at which they are going to cut back on their extraction of oil to contribute to compliance with the 2 degrees Celsius cap that was set by the Paris Agreement in 2015.
Right.
And the SEC has had sometimes they've sided with the company, sometimes they've not sided with the company on these climate change resolutions.
And that
so
process
we'll see.
itself is not just limited to ESG. It could be over any number of subjects,
Yeah,
and you
exactly.
have this process. But in this case, it's very focused on ESG.
Yeah. But my point is that the shareholder resolution, which BlackRock is probably part of, the Larry Finks of the world are part of, they're asking ExxonMobil to look forward and to say, as the world reduces its carbon footprint, how is that going to impact what you do, how you do business? I'm holding $1 billion of your corporate assets, and of your shares, and $1 billion in shares in Exxon. So if you don't take precaution to ratchet down how you spend your resources, I'm going to be harmed as a long-term investor. So, that kind of gives a sense for where these institutional investors are coming from when they're asking companies to look forward, look at the impacts of existing and potential externalities. And that requires a whole set of analysts and capacities. I had mentioned to you before we got started, there's a number of frameworks and tools out there.
Before we go on that point, let me jump in and parse what you just gave us, because it's really great, but it's pretty dense.
Yeah, sorry.
So first, for context, when you say $1 billion in X, Y, or Z company, I just want to make sure that we've thought through the fact that at any given moment, BlackRock has $4 or $5 trillion under management. So in the aggregate, just the 3 big players you listed have much more than $10 trillion. So it's an easy thing to have $1 billion in any given large company.
Right. Okay.
The scale here is large. So I just want to kind of put that out there. Now, the first part of your description around the Deepwater Horizon BP oil spill felt pretty good, because it kind of fell back into my traditional world of finance and governance, and it felt like it was a risk failure, and so you could kind of identify the board. And so in one way of speaking, what you're describing is a more attentive, thoughtful approach to risk assessment and cost-benefit analysis. Again, in finance, though it oversimplifies, we boil it all down to what is the net present value of this proposed plan, even if it has lots of cash flows, lots of costs, lots of risks. And in a way, the BP oil spill question was a critique of, did you appropriately identify these probabilistic risks? And should you put more cash into other efforts, safety, other thoughts? And did you weigh the risk appropriately, even though it was very low probability in this cash flow analysis? So in that world, it feels really good. Like I can take everything you said around that and then roll it back into a very traditional context, which is fantastic. Now, if then you switch to the Exxon example, yes and no. That gets harder, right?
Okay.
Because for ExxonMobil, one might argue, they're not bound by the Paris Accords, and their bread and butter is the extraction, and as it turns out, the creation of this, what we will call in economics, negative externality, right? So by extracting and making available hydrocarbons for use as fuel and energy, they are arguably making substantial profit, but also releasing into the world impacts around climate change and other factors that they don't directly bear the cost of. And yet they make profit on that. That one's harder because you could imagine that they might say, well, at least for now, we're abiding by the law. That accord doesn't apply to us. And we're making good money, right? And Goodyear's making really good money doing this. And you know, we hope that folks downstream, so to speak, using our products, use it wisely and carefully so as not to, I don't know, destroy the world. So, but that's really not on us. We're the folks who we're at the upstream part here. You guys got to fix that downstream. That's an argument that might be, and I'm kind of stylizing it to make it
but it's right on point.
So that tension there feels like real tension, right? So the shareholders, if you're really focused on just ExxonMobil, you say, well, don't get caught up in all that other stuff. Don't start saying you're going to drill less and extract more, and that sounds like low profit strategy to me. You focus. How do you reconcile that? Because that's a different net present value problem. That's I can't turn that into a formula as easily, so it makes it harder.
Right.
What do we do about that?
Right. Well, I think there's not a single answer to the question, and I think Exxon is doing exactly what you're describing. I mean, their argument to the SEC is that this requirement that they demonstrate how much they're going to cut back over a period of time is, they say, that's micromanaging how we do our business, and that is not. So we'll just have to wait and see what the SEC decides. It is a real dilemma, and it's a dilemma that companies writ large can get ahead of, I think, because I don't think ESG is going to go away. I don't think it's going to dissipate in terms of its pace at which it is being adopted. That's not to say it's universally adopted. That's not to say all pension funds, all institutional investors embrace an ESG strategy. It's certainly not to say all corporate America or corporate globe embrace ESG strategy. But it is something that's not going away, and it is distinct, if it's practiced correctly, distinct from your investor relations program, that project. So what Exxon, the creative tension for Exxon is to make its argument, say, let us just stay focused on what we're here to do, what our mission is, versus how they deal with these shareholders that are big shareholders who are saying, we want more attention, and we are in favor of a reduced carbon footprint, which opens up a whole nother can of rubber bands, as someone once said. And that is this a political decision that's driving these institutional investors to require or to ask that a company be required to do X, Y, and Z? That's a problematic place for institutional investors, because they are legally bound to do their fiduciary duty, exercise their fiduciary responsibility, which is make an investment solely for the welfare and benefit of the beneficiary. Exactly the same thing that shareholder primacy rule is all about, the same thing, the welfare of it. And so you have someone like Warren Buffett saying, you know, I really don't think politics should guide my business decisions, and therefore, I don't know if he says, therefore I reject ESG, but that is his quote. So that's another set of creative tensions. You've got the tensions that are being hammered out as a result of the process, this grassroots process of shareholder proposal, shareholder resolution, AGM votes by shareholders. And then you've got this in the discourse around ESG, around is this politically motivated or not? And I think the institutional investors have been very deliberate in terms, if you can talk about them in a whole group, of which they're very distinct, but an individual, but they've been very deliberate in terms of developing this ESG investment strategy in terms of risk as opposed to divestment. Now, there are institutional investors like university
Let's define
endowments.
divestment, by the way.
Yeah.
So in terms of risk, is kind of like we just framed it around the BP oil spill. You can have a rubric.
Yeah.
It fits into the overall framework of a board, and it's about costs and benefits and analysis and future forecasts.
Yeah.
Divestment, on the other hand, so what would a divestment strategy look like if it weren't just if as opposed to a risk framework? What's that
Right.
mean?
Well, divestment really preceded the whole ESG discussion.
Right.
And in fact, when I was a student at Vanderbilt, graduate student at Vanderbilt, I was head of the Graduate Student Council, and that meant I had a non-voting seat on the board of trust. And at that point in time, I'm dating myself. That point in time, apartheid in South Africa was the issue, and the board of trust voted to require the university to divest itself from all shares in companies that did business in South Africa. It was a fairly widespread thing that was happening in the United States at that point in time. And
which it points out that this intersection of politics and corporate behavior is not new.
No,
Right. This is a theme, and it ebbs and flows for sure. But there is precedent again and again, and I think divestment around South Africa apartheid issues is a good example that stands pretty starkly in U.S. corporate history, emanating from universities, but others as well. Came from. So go ahead. I just want to say that it's not new.
Yeah, and in contemporary terms, the issues around the gun lobby, CalSTRS has taken a very principled position on the gun lobby.
And that would be the S.
That would be the S.
ESG,
Yes,
right?
it would.
They've taken a social view.
Yes.
That they have a sense that this causes damage to their beneficiaries, the economy, the market. So they have both a market and a social view of that.
Right.
Okay.
Right.
Whether we agree or not, they've taken that view.
Right.
And they believe that companies. So I'm stretching here. So that companies therefore should what around that. So what does their view mean for operating companies? Does that mean if you're a big box sporting goods store, they might pressure you to do something different about the selling of guns, or what? Like, how does that show up for directors and managers of corporate entities?
Right. It's more likely the lobbying position is directed at gun registration, at policy solutions, as opposed to individual companies.
Right. Which is probably a little more fair to the companies, frankly, right?
Well, but it's also where they can have influence.
I see.
If you think about it. I mean, and also think about the number of stocks that they're going to be invested in, and the number of private companies they're going to be invested in as well. There's no way to, and that is micromanaging, and I don't think that's where their interest really is. But there is that whole divestment strategy for investing around ESG principles that's still very much practiced. The New Zealand Superannuation Fund, a small but very smartly invested fund in New Zealand. It's a sovereign wealth fund, but they handle the pension benefits.
Another type of institutional investor.
Another type of, And they, I think it was last year, maybe it was 2017, divested 40% of their passive portfolio, mind you, but 40% of their portfolio because it was in carbon-related stocks.
Right.
And they had a mandate from their board of trustees or governors and to reduce the carbon footprint.
Right.
And so they did that. So that was a political decision not made by the investor, but made according to the investment strategy. And each of these institutional investors, particularly the asset owners, has got that creative dynamic again between their board of directors and their investors. And that's a very important tension because the board sets the strategy.
Yes.
Just like in a corporation, they are a corporation, no they're not, but just like in a corporation, the board of directors sets the strategy. Management, they don't manage the risk strategy, they set the strategy. And there is, just going back to ESG, it just occurs to me that it might be helpful for your audience to be aware that there is increasingly good advice about what a corporate board should do to demonstrate it has its ducks in a row when it comes to these kinds of things. It doesn't mean that we're not going to have the debate about whether we should or whether we shouldn't. But if I'm the chair of a board of a publicly listed company, I'm going to get an analysis done, or if my manager, my CEO hasn't already done it, I'm going to get an analysis done of who my big shareholders are. And then I'm going to find out what each of those shareholders, where they stand on E
Right.
and S and G, and what the infrastructure they have, whether they have their own corporate governance team, or whether they let their portfolio managers handle that, or whether they outsource it to an asset manager. I'm going to find that out, and I'm going to make sure I've got policies and strategies in place that my C-suite can run behind and stand behind,
Right.
and operate in the current climate. No pun intended.
So I like that. So in short, there is a movement afoot that one might describe as embedding preferences in capital that aren't just about the black and white, short and medium term returns
Right.
on assets, but rather include preferences around these other bigger picture items, which in the very long term arguably may have real profound economic implications. So as we run out of time, I want to zero in on a couple of aspects. This, of course, is, as a practical matter, a teaser for this very big topic that really deserves a lot of attention.
It
And I
really
just
does.
wanted to kind of put it out there for people who are looking at finance and governance at the early stages. But let us imagine you had a magic wand that allowed you, as like the super policymaker and empress of the economy globally, to each year cause every active corporation to be assigned and accountable for both its positive and negative externalities.
Which
And
there
so-
are.
Right, and there are lots of these. And lots of companies produce lots of positive externalities, actually, and don't get credit for them, although maybe their brand is bolstered by that. And then lots of companies, arguably, are producing lots of negative externalities and don't pay the price for that, and hence reap excess profit. Very traditional view in economics, positive and negative externalities. We call it internalizing the externalities so that people behave in a more rational, market-clearing way. If you had that magic wand, would most of the ESG issues come into line? In other words, if Exxon were asked to pay and forced to pay each incremental cost that it causes downstream because of its extraction of oil from a carbon viewpoint, if we could magically know what that cost was, which would be hard, and we could assign it to them in pro rata, appropriateness, would that solve a lot of it? Because then when they do their budget, they'd have to say, oh, well, remember, at the end of the year, we're going to have to pay this, so this year we need to extract less or do it differently. Would this magical internalizing of all these positive and negative externalities, would that solve a lot of or make easier the decision making around ESG, including, let me give you another example. If you pay people too little for too long, their ability to be highly productive declines sometimes, or if you don't invest enough to train them. That's one argument. I think
Right.
that's, rising in prominence makes a lot of sense in some contexts. And so if you could track what that was doing, and a company had a balance sheet that said, human capital count this year went down 8% because we cut the budget for training and we
I think that's
paid people
available.
right. Yeah, and it went down. And then they had to pay, right, to make up for that. That would change the behavior. So if you had that magic wand, is that what ESG is, this internalizing of negative and positive externalities, or is there more to it than that? This is a giant question, and it's
it
our
is.
last one probably. So sorry for throwing it out there. Maybe give a run at it.
Well, it is a giant question, but it's also a very good question, and because it invites kind of an overview response, and that is what this is all about is encouraging boards in particular, as corporate governance moves to make boards more and more accountable, not only in the US but in UK and Europe, other places as well. But as that kind of thing happens, it's very important for future directors of companies, for current directors of companies, for people who are in management or aspiring to be aware of the holistic context in which decisions about investment get made and corporate decisions get made. So even if someone could be empress of the world and wave the wand and have all this happen, it would not take into account what is happening in the larger society. This does not just, ESG does not happen in a vacuum. It's happening in a larger community. And a big driver, by the way, of the evolution in corporate governance is the social media and media, 24/7 media. That plays a very big role.
Right.
And so there's this push to be aware of that kind of thing. There's demographic issues that are coming into play. So for your audience, I would think, being able to come together from various backgrounds and join in a discourse on these particular topics, which are knotty problems, which don't have one size fits all, which don't have a single solution, which will never get to the point where there is, ESG is solved because
Right.
it's just too dynamic. And if by chance that empress had such a terrific magic wand, she did achieve that, there'd be something else.
Right. Well,
So that's a very ingenious way to get a plug for your class.
yeah, well, I love it because as in all good pedagogical efforts, we have probably managed to leave our students with more questions than they started with.
good.
So
I hope so.
I like that phrase. We've opened up a can of rubber bands,
Yeah.
and someday we'll have to tackle that again and more thoroughly. But
Yeah.
thank you very much. This was
You're
really
welcome.
great. I appreciate your time.
You're very welcome.
Thanks.
Yeah, good.
All right.
Okay, hold.
Oh, so now we have to be quiet. They do a
Oh.
Please stay
calibration
quiet
thing just for about a
and-
minute.
Yeah, because her mic has a different setting for this shoot.
Oh.
So we're gonna begin room tone in 3, 2, 1. End room tone. Cut.
All right.
So they do this thing where they